Welcome back to the Insider Signal, where we track the market anomalies, the perfect strikes, and those financial situations where immense sums of money move just a little too elegantly for coincidence. We're talking about precision timing that really transcends mere research.
Indeed. And today we are really going to be researching in detail a case that, honestly, immediately sets off every single regulatory alarm bell in the system. It's the acquisition of Denny's Corporation, ticker DEN.
Ah, Denny's.
Yeah, and the truly extraordinary last-minute stock accumulation by the activist investor Jumana Capital.
When we say extraordinary, we mean the kind of move that, well, that young finance professionals spend their entire careers trying to replicate.
Yeah.
Or maybe trying to avoid investigating, depending on which side you're on. Picture this. A little over $1 million invested into a heavily distressed stock. It's a quiet Monday afternoon. The stock is basically bumping along near its 52-week floor. Hours later, after the market closes, the company announces it's being sold, delivering a stunning 52% premium.
Right there, that's the moment. That $1 million investment, poof, it becomes $1.54 million. An instantaneous, clean paper profit of $542,500.
Unreal.
Not over months, not even over weeks. We're talking overnight. So the question isn't really whether it was profitable, that's obvious. The question is, how do they know the when? That's the million-dollar question, or maybe the $500,000 question in this case.
That is absolutely the core mission of this particular session of Getting Into the Weeds. We're going to meticulously review the sources surrounding Jumana Capital's, let's call it, perfectly timed strike. We'll analyze this through the prism of M&A deal dynamics, aggressive activist pressure, and critically, that razor-thin margin separating brilliant market intuition from, well, the dark gray area of possessing and maybe acting upon informational certainty.
The tension is just inherent, isn't it? Especially when you're dealing with activist players. I mean, they publicly campaign for a sale. That is their stated goal. It's right there in the filings.
Sure, it's their whole playbook.
Exactly. But how far along were they in the actual negotiation process? How close were Jumana and the deal makers? Did that relationship, which started as mere shareholder advocacy, did it cross the line? Did it involve privy, non-public details that informed that final, highly profitable trade?
And for you, our sophisticated listener, whether you're a trader grinding it out, an M&A pro navigating these deals, or just someone who appreciates a masterfully executed value play, maybe with a side of suspicion, this Denny's case is, frankly, a masterclass.
It really is.
It illuminates exactly how these big deal premiums get generated, how activist pressure can force a board's hand, and the specific mechanisms the SEC uses or would use to scrutinize transactions when the timing appears, shall we say, preternaturally perfect.
Let's get into the weeds on this situation. It's quite a story.
Let's start with the setup.
Right. Context is key here. To truly appreciate the explosive nature of that 52% premium, we first have to paint a picture of Denny's before November 3rd. This wasn't the Grand Slam breakfast success story everyone remembers.
No, not financially anyway. It might be an American icon.
Yeah.
But the company itself was, let's say, struggling.
Struggling is putting it mildly. It was a highly distressed company. I mean, absolutely ripe for private equity intervention. The public market had essentially already sentenced the company.
You mentioned the stock price earlier. Down 32% year to date, even before this news.
Exactly. Down 32%. But you have to look deeper at the operational metrics. That's where the real warning signs were flashing bright red.
Okay, like what?
Like declining traffic. That's the killer in this sector. In Q3 of 2025, they reported a 2.9% same-store sales decline, and it was explicitly linked to fewer people walking through the door.
Yeah, declining traffic and casual dining. That's often the beginning of the end, isn't it? Signals maybe a lack of relevance or people are just too squeezed on price.
Precisely. And remember the backdrop. Severe inflationary pressure. Food costs, labor costs, everything squeezing margins across the entire industry. So you've got rising costs and fewer customers.
That's a recipe for disaster. An existential crisis, really.
It is. And management wasn't just sitting there. They were already in, well, let's call it full mitigation mode. They had already announced plans to cut their losses by closing a significant chunk of their restaurants.
Right, I remember that. Something like 70 to 90 locations.
Somewhere in that range, yeah. Underperforming ones. When a public company starts announcing mass closures like that, it's a very loud signal to investors. The core strategy isn't working, and they're shrinking just to try and survive.
And the stock price reflected that bleak picture, right? It hit a low just days before the deal.
It did. It touched its 52-week low of $3.89 on October 30th, just days before this whole thing blew up.
Okay, so distressed asset, iconic brand, wide footprint. that's like blood in the water for certain types of investors.
Absolutely. It's classic private equity bait. They see that struggling P&L not as a failure, but as a huge opportunity. Buy it cheap, take it private, do the dirty work the public markets hate, the restructuring, the closures, the heavy investment, and then maybe bring it back to market years later all cleaned up.
Which brings us squarely to the activist element. Enter Jumana Capital Investments, LLC.
Exactly. Jumana Capital. They're a Houston-based single-family office, relatively young, founded in 2018.
And that family office structure is important, isn't it? Gives them a different kind of edge.
It really does. They talk about their evergreen capital. That basically means they aren't tied to the usual PE fund life cycle, that typical 5 to 7 year clock demanding an exit.
Right. No limited partners breathing down their necks for a quick return.
Precisely. Jumana can afford to be more patient, take larger, longer-term positions, and wait for that perfect moment to really push or, as we see here, perhaps anticipate the push's success. It offers significant flexibility in how they run their activist campaigns.
And who's running the show there? You've got Christopher R. Martin as managing director, Adam Hirsch heading public markets.
Key figures, yes. But crucially, they weren't acting alone here. They had a partner, a well-known name in restaurant activism.
Ah, yes. JCP Investment Management, James Pappas.
That's the one. JCP, led by James Pappas. This alliance is critical to understand. Jumana and JCP, they're a known commodity, a collaborative force specifically in the restaurant space.
They've had some history together, haven't they? Mixed results, I recall.
Very mixed. They had that big win with Red Robin where Christopher Martin actually got himself onto the board. That's direct influence right there.
Right, inside the tent.
But then you look at their campaign at the Cheesecake Factory. Less successful. Didn't quite pan out. So it shows activism isn't some guaranteed path to riches, even for experienced players.
And they formalized this Denny's partnership relatively recently.
Yeah, they signed a formal group agreement back in September 2024, specifically to coordinate their strategy regarding Denny's, so they were unified, focused.
Okay, so we've got this seasoned, flexible, partnered activist team targeting a company that's basically advertising its own weakness. Now let's talk about their shield, their primary legal defense mechanism, the public filing.
The Schedule, 13D, filed in September 2025. This document is, for an activist, essentially their public declaration of war, or at least intent. It puts everyone, management, the board, the whole market on formal notice.
And what did it say? What was their stake?
The filing disclosed the group, Jumana and JCP together, held a combined 9.4% stake. Significant. Jumana itself held the bulk of that, about 7.8%.
Nearly 10%, but not quite. We'll come back to why that specific percentage might matter later.
Definitely. And the language in the filing was, let's say, carefully crafted but direct. They stated clearly they believed the stock was undervalued. Standard stuff.
Right. Boilerplate activist language.
And they plan to push for changes, again, expected. But here's the kicker, the sentence that provides that crucial legal cover we mentioned. The reason this filing is so central to Jumana's potential defense against any SEC scrutiny down the line.
Lay it on us.
The filing explicitly mentioned proposals including changes to capital allocation and, this is the key part, potentially a sale of either the whole company or parts of it.
There it is. Not just vague value enhancement. They specifically put a sale on the table publicly.
Explicitly. This is so important for anyone tracking these insider signals. They didn't just hint. They declared their goal was potentially a corporate transaction, a sale.
Why is that declaration so powerful as a defense?
Because it preempts the inevitable question. Why were you buying shares so aggressively right before a sale was announced? Jumana's answer is already baked into the public record. We were simply acting consistently with our stated, documented, publicly available investment thesis. We told you we wanted a sale, so we bought more stock because we believed that outcome was both desirable and achievable.
So it frames every subsequent purchase, even the, let's call it auspiciously timed ones we're about to get into, not as acting on secret info, but as conviction investing.
Exactly. Conviction based on their public stance. It's a masterful piece of legal foresight, building the defense narrative months in advance.
Okay, the stage is set. Vulnerable target, aggressive activist, publicly demanding a sale. Let's look at the deal itself. All right, let's shift gears from the pressure campaign to the dramatic climax. The acquisition, announced on the evening of November 3rd, 2025. What were the headline numbers?
Big ones. It was a $620 million enterprise value deal. a take-private transaction structured around a consortium of buyers, which is pretty typical when you're dealing with a struggling restaurant chain that needs a serious operational overhaul.
And who was leading this consortium?
The lead acquirer was Jumana Capital Advisors. They're a private equity firm with real chops in the restaurant sector. They know the space inside and out.
Right, they've done deals like P.F. Chang's, TGI Fridays. They're not afraid of a turnaround project.
Definitely not. They specialize in taking these struggling brands private, implementing those painful but necessary changes away from the public market's glare. But they weren't alone.
Who else was involved? You need money and operational expertise.
Exactly. They brought in Trevel Capital Group to handle the significant debt financing piece, a hefty $335 million secured package, and maybe the most interesting player in this group, Yadav Enterprises.
Yadav.
Yeah.
They're a huge Denny's franchisee, aren't they?
Massive. Operating something like 550 Denny's locations. Their inclusion in the buyer consortium is a really powerful signal.
How so? What does it tell us?
Well, two key things, I think. One, it shows deep current operational confidence from someone on the ground. They believe in the brand's potential despite the corporate struggles. And two, it signals they're willing to put their own skin in the game, their own money and expertise to fix the corporate strategy. They probably felt the existing setup was holding back their own success as operators.
Makes sense. It aligns the incentives nicely. Avoids that potential conflict between a new PE owner making top-down decisions and the key people actually running the restaurants day-to-day.
Right. It de-risks the execution significantly. Triartis of lead, Rohit Manoka, even gave that quote about Denny's being an iconic piece of the American dream.
Standard PE deal talk.
Yeah.
But the real poetry, as always, is in the numbers. What was the actual price per share?
The price was $6.25 per share, all cash.
Okay, $6.25. Now connect that to where the stock was trading. This is where the premium analysis just gets wild.
It really does. That $6.25 price represented a jaw-dropping 52.1% premium over the closing price on November 3rd, which was just $4.11.
52%. For a company shedding customers and closing stores, that's enormous.
It's huge. And this is precisely why the timing of Jumana's final trades becomes so incredibly suspicious. A premium that large implies one of two things. Either the public market was spectacularly wrong about Denny's value, or the buyers saw massive operational upside that was just invisible or maybe unbelievable to the street.
Let's dig into that valuation gap. How does a PE firm justify paying $6.25 when the market says $4.11? What are they seeing?
They're almost certainly not valuing it on current performance. They're looking at projected normalized EBITDA, likely several years out after they've executed the turnaround.
Okay.
So Denny's was probably trading publicly at a really low multiple of its depressed current earnings, maybe, I don't know, 4 or 5 times EBITDA. But Triartisan, to get to $6.25, they were likely applying a much healthier multiple, maybe closer to 8x or 9x, to what they believe the earnings will be once they fix things.
So the premium essentially represents the value of the operational fixes they plan to implement privately.
Exactly. The cost cuts, the efficiency gains, the reinvestment, all done away from quarterly earnings pressure. The gap between the public multiple and the private multiple is the turnaround plan's value. Capitalized.
Now, how did Denny's board get to that number? Did they run a full auction?
Well, they certainly claimed they did. The CEO, Kelly Valade, put out a statement saying the board conducted a thorough process, reached out to more than 40 potential buyers, and received multiple offers. They had Truist Securities and Morgan Lewis advising them.
Standard language to show they met their fiduciary duty, got the best price possible for shareholders.
Precisely. Protects the board. But the timeline still feels incredibly tight, doesn't it?
Yeah, especially considering they actually canceled their scheduled Q3 earnings call on November 3rd. The reason given was in light of the announced transaction.
Which suggests one of two things. Either the final negotiations came together extremely fast, like in the final days or hours, or the entire process was kept under incredibly tight wraps, highly confidential until the absolute last second.
Either way, it adds to the feeling of suddenness.
And the strategic rationale for going private is just textbook M&A 101, especially for this sector. Escape the public market spotlight.
Right. You can't easily close 80 restaurants and tell Wall Street, trust us, it'll be better in 3 years. The stock would get hammered short term.
Exactly. Triartisan bought the company specifically to do that painful work during an operational quiet period without worrying about quarterly EPS targets. It's the standard go-private playbook for distressed retail or restaurants.
And the deal was firm. Financing was locked.
Absolutely. The announcement stressed there was no financing contingency. They had committed equity from Triartisan and Yadav, and that $335 million secured debt package from Travelit was locked in. That certainty is why the stock jumped right up near $6.25 the next morning.
Any standard deal protections? Breakup fees?
Yep, the usual guardrails. A $10.32 million termination fee if Denny's walked away for a better offer, and a $17.2 million reverse termination fee if the buyers failed to close. Pretty standard stuff, showing commitment on both sides. Expect to close in Q1 2026, pending the usual shareholder vote and regulatory nods.
Okay, so the M&A context is clear. Massive premium, standard go-private rationale, activist already pushing for it now. Let's zoom in on Jumana's actions in the run-up. This is where it gets really interesting.
Right. This is where we leave the broad strokes and really get into the weeds, the granular details of the trading activity. Jumana hadn't just appeared on November 3rd. They'd been active.
They were buying earlier as the stock was falling, correct?
Yes. Throughout October 2025, as Denny's stock was plumbing those depths near the 52-week low, Jumana was steadily accumulating shares. Strategically buying the dip, you could say.
Do we have specific dates and amounts for those earlier buys?
We do. Filings show purchases on October 17th, October 20th, and October 21st. During that short window, they picked up about 183,000 shares.
Okay.
Total cost was around $925,000. If you look at the prices then, they were averaging somewhere between $5 and $5.15 per share. So higher than the eventual bottom, but clearly they saw value even as the stock was dropping.
Which fits the conviction investing narrative we talked about.
Yeah.
Doubling down on your thesis when the price gets cheaper. Standard activist move.
It is. But things get a little more complex right around that October 21st date. There was some interesting derivative activity happening simultaneously. Options. Specifically, on October 21st, Jumana sold 6,600 call option contracts. These had a $5 strike price and expired on November 21st.
Selling calls. Okay, that could be a few things. Maybe hedging their existing long position, generating some income, possibly structuring a more complex position.
Could be any of those. It shows sophisticated position management, certainly. But here's the thing that really lights up the signal flares for professional traders. What else happened in the options market on that exact same day, October 21st?
The unusual options activity. I remember reading about this.
Yes. Market surveillance systems, the exchanges and the SEC run, detected a massive anomalous spike in overall call option volume for Denny's stock. We're talking a 662% increase compared to normal volume.
600%, wow.
Yeah. Over 6,600 call contracts traded that day, heavily weighted towards near-term expiry like those November $5 calls Jumana was involved with. This happened a full 2 weeks before the acquisition was announced.
Okay, so that implies someone, not necessarily Jumana, but someone out there in the market, suddenly got extremely bullish around October 21st. Betting aggressively that the stock would pop above $5 soon.
Precisely. That kind of option spike is often seen as the whispering wind of information. It strongly suggests that the M&A process, maybe the outreach to those 40-plus buyers, was likely entering its final, most intense phase. The point where NDAs are signed, term sheets are flying, and the risk of leaks, however small, increases dramatically.
Fascinating. The options market smelling smoke before the fire is visible.
Often happens. Now let's fast forward. We navigate through the end of October, the stock hits that $3.89 low, and then we arrive at the critical day, Monday, November 3rd, 2025, the day the stock would close at $4.11.
And this is the moment of truth.
Yeah.
The moment of maximum conviction, or perhaps maximum informational certainty.
This is the trade that raises all the questions. During regular trading hours on November 3rd, we're talking hours, maybe just a few hours, before the market closed and the announcement hit, Jumana executed a massive purchase.
Not massive.
250,000 shares, bought at an average price of $4.08 per share. The total value of that single day's trade was just over $1,020,000.
$1 million in one go on the day of the announcement.
Not a slow accumulation over weeks. A large single-day strike right near the absolute low, hours before the news.
You have to ask yourself, if you're that activist you've been buying steadily, why unleash your single biggest recent purchase right then? Unless you were incredibly confident that the window of opportunity at that price was about to slam shut permanently.
And slam shut it did. Hours later, after the market closed, Denny's announced the $6.25 per share all-cash acquisition by the Triartisan Consortium.
What was the general market activity like that day? Did the volume spike suggest broader leaks?
Interestingly, no, not really. The overall trading volume in Denny's stock on November 3rd was only about 1.3 times its normal average daily volume, not a huge surge.
Okay, so maybe not widespread leaking.
It suggests that if there was specific information floating around about the imminent announcement, the circle of knowledgeable individuals was likely very, very tight. Or perhaps limited to just one particularly large convicted buyer making their move.
And that move paid off handsomely, instantly.
Instantly. That specific November 3rd purchase of 250,000 shares at $4.08 yielded an immediate paper profit of $2.17 per share the moment the $6.25 deal was announced.
Which translates to?
Translates to approximately $542,500, a 53% gain on that $1 million materialized in a matter of hours.
$500,000.
Yeah.
Earned between market close and the press release hitting the wire. That just looks bad, doesn't it?
Uh-huh.
It's the kind of timing that practically screams for regulatory attention.
It's the absolute textbook definition of a trade that regulators cannot and will not ignore. Now, after this final purchase, where did that leave Jumana's total stake?
They got close to that key threshold, didn't they?
Very close, but deliberately short. Their filings show that after the November 3rd buy, Jumana directly controlled 4,524,905 shares. That worked out to exactly 8.79% of Denny's outstanding stock.
8.79%. Let's pause there. Why is staying under 10% so significant, especially for our finance-savvy listeners?
It's absolutely critical from a legal and regulatory standpoint. Under Section 16 of the Securities Exchange Act of 1934, once you cross the 10% ownership threshold, you are automatically deemed a statutory insider.
Which triggers a whole host of things.
A whole host. Stricter reporting requirements on trades, significantly increased liability under insider trading rules, and most importantly, you become subject to the short swing profit rule.
Explain that one quickly.
Rule 16b. It basically says if a statutory insider makes a profit from buying and selling, or selling and buying, the company's stock within any 6-month period, that profit generally has to be disgorged, paid back to the company. It's designed to prevent insiders from profiting on short-term speculation based on their access.
So by staying meticulously at 8.79%, just shy of 10%, Jumana got the influence that comes with a large stake, but they legally avoided the automatic burdens and the short swing profit liability that kick in at 10%.
Exactly. It demonstrates extreme legal and financial sophistication. They wanted the power, the influence, the exposure to the upside from their activism, but they deliberately structured their holdings to maintain a legal firewall against being automatically classified as a traditional insider. Very smart maneuvering.
And their activity didn't stop right after the announcement, did it? They kept managing the position.
That's right. Even after the deal was public and the stock had popped, they were still actively managing risk. On November 7th, just a few days later, filings showed Jumana purchased put options.
Buying puts. So betting the price might go down.
Not necessarily betting it will go down, but hedging against the possibility. The puts referenced about 200 and 1,100 shares. This looks like pure, sophisticated risk management during the merger arbitrage phase. Meaning, okay, the deal is announced at $6.25. The stock jumps to, say, $6.18. There's still a small spread because the deal isn't closed yet. There's always a tiny risk it could fall apart. Regulatory issues, shareholder vote fails, whatever. Buying puts protects some of their massive paper gains if something unexpected did derail the deal before closing. Standard merger arb hedging.
Got it. So the entire sequence, from the initial 13D declaration demanding a sale, through the accumulation, the options weirdness, the perfectly timed final large buy, staying under 10%, and then hedging the gains.
Yeah.
It paints a picture of extreme precision.
Extreme precision. But it's that November 3rd purchase, that $500,000 overnight profit, that stands out as the single data point where precision starts to look suspiciously like, well, near certainty.
Okay, let's put on our legal hats, or maybe our regulatory investigator hats,
Yeah.
and walk through the legal tightrope here.
All right, the timeline is established, the suspicious trade is identified. Now we need to apply the legal framework. And let me stress again, we're researching in detail what the SEC would look at here. We're not accusing anyone of anything illegal, just analyzing the situation based on the publicly available facts and standard legal theories.
Absolutely. And as folks who've, worked in and around M&A, we know our audience understands the basics. So let's not just define the SEC theories. Let's really apply them directly to Jumana's specific actions and position here.
Good point. Let's start with the theory that probably doesn't fit neatly. The classical theory of insider trading.
Okay, refresh us quickly. Who does that target?
The classical theory targets traditional corporate insiders, officers, directors, and controlling shareholders who owe a direct fiduciary duty to the company's shareholders and trade on MNPI obtained through their position.
MNPI being material non-public information. The secret sauce.
Exactly. The key here is that Jumana, at 8.79% ownership, wasn't a controlling shareholder in the traditional sense, and critically, they held no board seats. They hadn't been designated a fiduciary by Denny's management through some special committee role either, as far as we know.
Right, so they maintained that crucial distance. Unlike their Red Robin campaign, where putting a principal on the board totally changed the legal landscape for them. Staying off the board here provides a significant legal shield against this specific theory.
It does. Which brings us to the two theories that are much more relevant and, frankly, more likely to be the focus of any SEC inquiry in a situation like this. First up, the misappropriation theory.
Okay, what's the angle there?
Misappropriation prohibits trading on MNPI again, the secret sauce that was obtained in breach of a duty owed not to the company traded, but to the source of the information.
So the duty is owed elsewhere, like to an employer or a client.
Exactly. Think about the potential sources here. An investment banker at Truist advising Denny's. A lawyer at Morgan Lewis working on the deal docs. Even an executive at Denny's who shares info confidentially. If any of those people shared critical details with Jumana, say, the final $6.25 price or the exact announcement timing, they would be breaching a duty of trust and confidence they owe to their firm or their client, Denny's.
And if Jumana then trades based on that leaked information.
And Jumana becomes the misappropriator. They've essentially stolen confidential information belonging to the source, the banker's firm, the law firm, Denny's itself, and used it for their own profit.
So the key question for the SEC under this theory would be, did Jumana receive information under circumstances where they knew or should have known it was confidential and originated from someone breaching a duty?
Precisely. Did they sign an NDA with Denny's or their advisors as part of the M&A discussions? That would be a slam dunk breach if they traded. Even without a formal NDA, sophisticated players like Jumana often operate under what courts call implied duties of confidentiality, especially when they're receiving sensitive updates about a potential strategic transaction they themselves advocated for.
Regulators would be digging through emails, call logs, meeting notes, looking for any evidence that Jumana was brought over the wall or given information with an expectation, explicit or implicit, that they'd keep it quiet and not trade on it.
Absolutely. They'd scrutinize every interaction. And there's no question that the information itself, the final $6.25 price, the 52% premium, the imminent announcement constitutes material, non-public information. That part isn't debatable.
Okay, so misappropriation is one angle. What's the other main theory?
The other big one is tipping theory, or tipper-tippy liability. This is probably the most commonly understood version of insider trading.
How does that work?
It requires a few elements. First, you need a tipper. Typically a corporate insider, like a Denny's exec or director, or potentially a temporary insider, like the banker or lawyer under misappropriation theory who possesses MNPI. Second, the tipper must disclose that MNPI to an outsider, the tippee, Jumana, hypothetically. Third, the tipper must do so in breach of their fiduciary duty, and importantly, for a personal benefit.
The personal benefit element. That's always the tricky part to prove, isn't it?
It is. The Supreme Court has wrestled with this. The benefit doesn't have to be direct cash payment. It could be reputational enhancement, career advancement, building goodwill for future deals, or even just making a gift of confidential information to a trading relative or friend. But some kind of benefit to the tipper, however indirect, must be proven.
And then the tippee, Jumana in this scenario, has to know or should have known that the information was confidential and disclosed improperly for a personal benefit. And then, of course, they trade on it.
Exactly. So the SEC's focus here would be identifying potential tippers who inside Denny's or its advisors, or even the buyer consortium like Yadav, had the MNPI and a potential motive to tip Jumana. And what was the potential benefit exchange? It's a high bar.
This leads us straight into that activist gray area we mentioned. Activists like Jumana, by their very nature, are constantly talking to management, pushing for M&A. That proximity makes them uniquely vulnerable to receiving sensitive information, intentionally or not.
It's a real tightrope. They need access to push their agenda, but that access increases the risk of exposure to MNPI. The critical unknown here is, What exactly was Jumana told about the strategic review
Mm.
process? Were they formally brought over the wall under an NDA? Were there informal updates that crossed the line?
The potential conduits for information are certainly plausible, even without proof. Denny's management giving updates to a major shareholder who's pushing for a sale, investment bankers sounding out key investors, maybe even someone at Yadav Enterprises, the franchise who joined the buyout, sharing insights.
All plausible pathways. But again, proving that specific MNPI was transferred and that it was done in breach of duty for a personal benefit for tipping or received under a duty of confidentiality for misappropriation requires concrete evidence.
Which brings us to the core challenge for any prosecution. Proving scienter. That's the legal term for guilty knowledge or intent, right?
Correct. The SEC doesn't just have to prove Jumana traded profitably before the announcement. They have to prove Jumana traded while knowingly possessing MMPI that they knew or should have known was obtained improperly. Without direct evidence, the smoking gun email, the recorded call, the cooperating witness proving scienter based purely on circumstantial evidence like suspicious timing is very, very difficult.
Especially when the defendant has strong counterarguments. So let's lay out Jumana's likely legal defenses here. What would they argue if the SEC came knocking?
Defense number one, and it's a big one, is the public cover defense. Keep coming back to this.
The September 13D filing.
Exactly. That filing is invaluable to them. It publicly and explicitly advocated for a sale. Therefore, they can frame any subsequent stock purchase, including the highly suspicious November 3rd one, as simply being consistent with their stated, documented public investment thesis. We told the world we wanted a sale. We bought stock because we believed in that outcome.
It sets the narrative. Conviction, not inside information.
Right.
What's defense number two?
The value play argument. Look at the stock price. It was trading near its 52-week low, hitting $3.89 just days before. Jumana bought the final tranche at $4.08. They can plausibly argue this was simply an opportunistic value investment, completely independent of the timing of the announcement. The stock was incredibly cheap based on its intrinsic value or potential turnaround value. We bought it because it was a bargain.
Makes sense. Buy low, hope for the best. And the third major defense.
The most sophisticated one, and often very effective, the mosaic theory defense.
Ah, the mosaic, piecing things together.
Precisely. Jumana would argue they didn't receive or rely on any single piece of MMPI. Instead, they diligently gathered numerous pieces of publicly available information, the tiles of the mosaic, and through their superior skill and analysis, pieced them together to form a more accurate picture of the company's prospects and the likelihood of a near-term transaction than the general market had.
Okay, let's detail those potential tiles for our listeners. What public info could they point to?
Oh, plenty they'd point to. 1. Denny's own dismal Q3 performance, the traffic declines, the store closure plans, clear signs of distress prompting board action. 2. The broader industry context, other casual dining chains like Red Lobster or TGI Fridays going private, showing PE firms were actively hunting in this sector. 3. Public analyst reports, maybe discussing Denny's high leverage or the potential value unlock from a sale or restructuring. 4. The options market activity, that huge spike in call volume around October 21st was public data, signaling someone expected news. 5. And crucially, their own activist pressure via the 13D filing. They knew they were pushing hard, increasing the odds of a sale.
So the argument is, we connected the public dots better than anyone else. Our analysis suggested a sale was imminent and likely undervalued by the market. Buying at $4.08 was just smart legal analysis in action.
That's the essence of it, and it can be a very powerful defense. It acknowledges they had an edge, but claims the edge came from skill and public data, not illegal secrets.
So it really comes down to that legal tightrope. The timing of the November 3rd trade, capturing that huge instant profit, looks incredibly suspicious circumstantially.
Highly suspicious.
But Jumana has a pre-built legal narrative rooted in their public filings and plausible analytical arguments. Without that smoking gun proving they knew the deal specifics beforehand, suspicion alone often isn't enough to win a case.
And one more point reinforcing their defense. As far as public records show, there are no obvious direct business or personal ties linking the key people at Jumana to the key people at the acquiring firms Triartisan, Trivial, or Yadav.
Right. No smoking gun connection that makes a tipping scenario obvious. That lack of a clear pathway makes proving misappropriation or tipping significantly harder for regulators.
It forces the SEC to rely much more heavily on circumstantial evidence and inferences, which are always tougher to prove in court.
Okay, so the legal battle lines are drawn. What are the key pieces of information we don't have, the unknowns that regulators would desperately want to uncover?
Right. We've established the gap between that strong suspicion fueled by the timing and the legal certainty needed for prosecution. To bridge that gap, regulators would need access to information that, right now, resides only within the inner circle of the deal team, the Denny's board, maybe Jumana's internal records.
Let's outline exactly what the SEC would be looking for if they opened a formal investigation. What are the critical missing pieces that could turn suspicion into a solid case? It feels like it all revolves around confirming the actual deal timeline versus the public narrative.
Absolutely. First and foremost, the precise deal timeline. That vague statement about contacting 40-plus potential buyers isn't enough. When did that outreach actually begin in earnest? When did Triartisan first submit a serious indication of interest? When did negotiations get exclusive? When was the $6.25 price actually agreed upon internally?
How does that timing impact the view of Jumana's trades?
Massively. If, say, serious outreach only began in mid-October and Triartisan firmed up its offer on November 1st or 2nd, then Jumana's large purchase on November 3rd looks much more questionable than if the process had been dragging on since July with multiple bidders involved. The vagueness in the company's press release about the process is, frankly, unhelpful from a transparency perspective, though perhaps strategically understandable.
Okay, so pinning down the exact sequence of events is crucial. What's next on the SEC's wish list?
The Holy Grail. Communication records. Subpoenas would fly. They'd demand every email, every text message, every calendar entry, every phone log between Jumana principals, JCP principals, key Denny's executives and board members, the bankers at Truist, the lawyers at Morgan Lewis, and probably even relevant people at Triartisan and Yadav.
Looking for what, you specifically?
Looking for any explicit proof that MNPI was shared. Did a banker email Adam Hirsch saying, looks like $6.25 is the number, announcement likely Monday night? Did a Denny's exec text Chris Martin, deal signed, expect news after close? Any written or recorded evidence confirming the transfer of the price, timing, or certainty of the deal before it was public? That's the smoking gun.
Absent a smoking gun, what else would they probe?
They would focus intensely on the specific rationale for the November 3rd trade. Why that specific large volume, 250,000 shares over $1 million on that specific day? Was it just a gut feeling? Was it based on a specific piece of analysis completed that morning? Or was it triggered by something else?
And this ties back to something we touched on earlier, the absence of a particular type of trading plan that could have provided a defense here.
Exactly. We need to explain the significance of Rule 10b5-1 plans for our audience because their absence here is notable.
Good. What is a 10b5-1 plan and why does it matter?
Okay, so Rule 10b5-1, established by the SEC, allows corporate insiders and large shareholders to set up a prearranged written plan for trading the company's stock at a time when they are not in possession of MNPI. The plan specifies future trades based on objective criteria like specific dates, specific prices, or specific volume targets.
So it's like putting your trading on autopilot.
Essentially, yes.
Right.
If you establish a proper 10b5-1 plan in good faith before learning any secrets, trades executed under that plan later on are generally given an affirmative defense against insider trading allegations, even if you happen to possess MNPI when the trade actually executes. The argument is the decision was made earlier objectively.
So if Jumana had publicly disclosed a 10b5-1 plan back in, say, September, stating, we will buy 250,000 shares of DEN if the price drops below $4.10 in November.
Then their November 3rd purchase at $4.08 would have an ironclad defense. They could say, look, the trade was pre-programmed based on price. It executed automatically according to the public plan. It had nothing to do with the announcement timing.
But there was no such publicly disclosed plan for Jumana regarding this trade.
Correct. No 10b5-1 plan covering this specific purchase was publicly filed. This leaves Jumana needing to justify that large, highly profitable, last-minute discretionary trade based purely on real-time market observation and their public thesis. It's a potentially harder story to sell, legally speaking, given the outcome.
Okay, let's talk about the regulators themselves. What's the likely status? Any signs of an investigation?
Well, as we noted, the SEC operates with strict confidentiality during investigations. So the fact that, as of our research date shortly after the deal, no public SEC investigation has been announced means absolutely nothing. That's standard procedure.
These things take time, often years.
Exactly. Investigations can take 2, 3, even 5 years or more before they result in a formal complaint, a settlement, or are quietly closed with no action. But behind the scenes,
You think their systems flagged it?
oh, absolutely. We can say with near certainty that the SEC's sophisticated automated trading surveillance algorithms run by their market abuse unit would have flagged this November 3rd transaction immediately. The combination of factors, the size, $1 plus, the timing, hours before announcement, the massive premium, 52%, the activist context, it hit every single red flag metric. It would have triggered a mandatory internal review.
So an inquiry was almost certainly opened internally. What about the odds of it going further?
That's the harder question. Likelihood of a preliminary inquiry, high to medium, almost certain given the flags. Likelihood of a formal investigation leading to prosecution or a settlement, that's lower, maybe low to medium at best.
Why the lower odds for prosecution, despite the suspicious look?
Simply because of the difficulty, as we've discussed, of proving scienter that guilty knowledge without direct evidence, especially when Jumana has that strong 13D public cover and the plausible mosaic theory defense. The SEC has to weigh the strength of their evidence against the resources needed for litigation and the risk of losing in court.
Makes sense. Now let's widen the lens slightly. How did other sophisticated institutional investors play Denny's during this period? Does their positioning make Jumana's timing look even more unique?
It really does. Looking at institutional filings from Q2 and Q3 2025, just before the deal, provides fascinating context. You see some big names completely misjudge the situation.
You mean the wrong sellers?
Exactly. Huge, smart money managers like Wellington Management, Olstein Capital, filings showed they sold their entire positions in Denny's, often over 1 million shares each during the second and third quarters.
Ouch. They saw the terrible fundamentals, the declining traffic, and basically gave up on it, missing that massive 52% premium entirely.
Completely missed it. They were right about the operational struggles, but spectacularly wrong about the timing or likelihood of a value-unlocking catalyst like a sale.
Okay, so some smart money got it wrong. What about firms that were buying? Were others as aggressive or well-timed as Jumana?
There were definitely some aggressive buyers, sophisticated value firms, who saw the potential opportunity earlier in Q3. Think firms like Millennium Management, Hotchkiss & Wiley. They added large positions.
So they sniffed out the value play, the turnaround potential, the activist angle.
Yes, they clearly identified Denny's as undervalued and potentially in play. Their conviction was sound. But crucially, their accumulation happened earlier, over weeks or months in Q3, and likely at slightly higher average prices than Jumana's final, precise $4.08 entry point right before the announcement.
So other smart money saw the if there's a turnaround or sale, it's cheap. But Jumana seemed to nail the when.
That's the key distinction. This institutional positioning review confirms that even among the most sophisticated hedge funds and value investors actively analyzing Denny's, Jumana's timing on that November 3rd trade was exceptional. It stands out. It wasn't just good value investing. It looks like something closer to event-driven certainty.
Which brings us back full circle to the central question. How do we synthesize all this for the listener? What are the plausible scenarios the SEC is likely weighing internally right now?
I think it boils down to 3 main possibilities, ranging from innocent to illegal.
Okay, lay them out. Scenario 1. The phenomenal coincidence.
This is Jumana's primary narrative. They had a public thesis, the 13D, advocating a sale. The stock hit a technical or fundamental price target, $4.08 near the low.
Yeah.
They had capital allocated to the idea. They simply pulled the trigger based on their ongoing analysis and general market conditions. The fact that the acquisition was announced hours later was just extraordinary, once-in-a-career luck. Possible? Yes. Plausible? That's for regulators to decide.
Okay, luck. Scenario 2. The superior mosaic theory.
This is the sophisticated gray area. Jumana argues they received no single piece of definitive MNPI. However, being deeply engaged activists, they were in constant legal communication with management, bankers, maybe other shareholders. They legally pieced together numerous public and maybe some non-material private tiles. The options spike, industry trends, the vibe from management calls, maybe even the sudden cancellation of the earnings call to conclude with a very high degree of confidence that the deal was happening that specific evening. They then acted aggressively on that superior but technically legal analytical edge. Highly risky behavior, but potentially defensible if no specific MNPI rule was broken.
High conviction analytical conclusion, not a leak. And finally, scenario 3. The receipt of MNPI.
This is the illegal scenario. Through one of those potential conduits, we discussed a banker breaching duty, a company executive tipping for personal benefit, maybe an accidental disclosure they knew was confidential. Jumana received specific material non-public information. Likely the final price, the definite timing, or confirmation the deal was absolutely done. They then traded directly on that illegal certainty to capture the immediate $542,500 windfall on that November 3rd purchase. This would clearly violate SEC rules under either misappropriation or tipping theories.
So luck, brilliant legal analysis, or illegal information.
Those are the core narratives. And that November 3rd timing, that $500,000 instant profit, remains the single most uncomfortable piece of evidence pushing against Scenario 1 and 2, making Scenario 3 the focus of any serious regulatory scrutiny, despite the significant hurdles in proving it.
It really is a fascinating illustration of the high-stakes, high-risk game played constantly in the world of activist investing and M&A.
Absolutely. The lines can be incredibly fine. #OutCheckOutro.
So we have spent our time today researching in detail the truly extraordinary dynamics surrounding the Denny's acquisition. We had a vulnerable company, bleeding customers and closing stores. We had a determined, sophisticated activist investor in Jumana Capital, publicly demanding action. And then we had that perfectly executed seven-figure stock purchase, just over $1 million, hitting the tape mere hours before a $620 million buyout announcement delivered a stunning 52% premium.
Yeah, that single trade yielding over $500,000 basically overnight is the absolute textbook definition of market signaling that demands, and certainly received, a close regulatory look. Jumana's overall gains on their Denny's position were substantial, ranging from maybe 25% on some of those earlier October buys up to that eye-popping 53% on the final November 3rd tranche. It just perfectly underscores the massive immediate financial reward tied to knowledge asymmetry in these situations.
And I think what we've learned here and what we see time and time again in these cases is that while activist pressure might be necessary to force strategic change, the most significant risk, and let's be honest, the most significant reward often lies not just in knowing if a sale or major event will happen, but possessing that critical, precise knowledge of when. When exactly will the change finally materialize?
That's spot on. For sophisticated market participants, for the traders and analysts listening, knowing the if is relatively cheap. Your fundamental analysis, your industry comps, your understanding of activist playbooks can tell you if a company is undervalued or likely to be sold eventually. But knowing the when, that is absolutely invaluable.
That's the alpha.
That's the alpha. It's the difference between being a smart, patient value investor who might eventually be right and being a perfectly positioned trader who captures the maximum profit with minimal time risk. Jumana, in this instance, played it like the latter, whether through luck, skill, or something else. Well, that remains the question.
An absolutely intriguing signal to track in the coming months and perhaps years. We will certainly be keeping a close eye on any further filings, any whispers from the regulatory corridors, or any follow-on effects from this transaction.
Definitely one to watch. Well, thank you for getting into the weeds with us today on this fascinating case. Until next time, keep your eyes peeled and keep analyzing those signals.
And stay sharp.